Emira Property Fund, reporting distribution growth of 3.5%, that for its financial year to the 30th of June 2013, achieving a positive turnaround from last year's decline in distributions. Emira's participatory interest holders receiving a total return of 26.2% for the year and a capital return of 17.3%. James Templeton, CEO of Emira Property Fund, is here in studio to unpack the numbers. Thanks for joining us. So it's great numbers to deliver in terms of the fact that you are seeing a turnaround, you're seeing an improvement in vacancies. But just run us through the strategy that you have had in place and that's leading to this turnaround in the metrics.
Thanks, Samantha. Sure. Almost half of our portfolio currently sits in office space, and that is a market that's been under pressure for the last couple of years. About 35% is retail and about 16% is industrial. So the focus has been very much on office space, and the strategy there has really been multifold. We've increased the staff component that we have in our team. We've increased the staff by 7 additional people, primarily focused on leasing in the past 12 months, taking it to 18 people. So we've got a small staff member and a staff member force. So the staff component has increased. We've been spending money on our buildings. The capital expenditure pipeline in Emira at the moment is 600 million rand. So we've been upgrading our assets in terms of quality, and that excludes sort of maintenance and refurb, which is another 30 million rand a year.
What does that do for customer retention? What does that do for the ability to up the cost of rentals?
Yeah, it's critical. First of all, you've got to defend your turf. You've got to make sure that you retain your tenants. And tenant retention increased from 65 to 78% during the period. So one, you've got to retain your tenants, and two, you've got to try and attract new tenants, and for that you need to put attractive rentals on the table. You've got to get your buildings looking good, and you've got to have the contacts and the network.
But 50% of your portfolio is in the office space right now, and if you just look at the industry average, you're looking at vacancies just over 11.07%. You're sitting at 10.7%, so slightly below that, but that's very high relative to other sectors. Are you looking to change the mix when it comes to your portfolio of assets away from such a large focus on office?
Sure. I think the strategy there is, one, we've got to get the vacancies down from the already better than market 10.7%, and we've got ambitious plans for the coming year. And then secondly, we are growing our existing asset base. For example, Warner Park Shopping Centre, which is our biggest asset, we're spending 500 million rand there, and that's on a retail asset. We've got another big asset in Pretoria, which we're probably also going to spend in the region of 300 million rand. So we are looking after our office assets, and we're also trying to grow our retail assets through existing capex and through acquisitions.
I find it interesting, this discussion around whether we've got too much retail space, too many malls in South Africa, and you're spending majority of your capex spend going forward on this Warner Park shopping mall. So what are your thoughts in terms of the return that you're going to get from investment in this regional super mall? Sure.
I think first of all it's important to realise that the demand for space is tenant driven. We have gone out there and we have canvassed tenants. They have come to us. So we are 93% let on the capex project at Warner Park, which will be completed in November 14. So it's tenant driven, and that return at about 8.5% return is better than we can get by buying assets. So we're spending our money at and it's going to earn a return which is better than buying out there. So, and it's earnings enhancing, so it makes sense.
So does it depend on the location right now in terms of which shopping malls, which retailers, which retail spaces are going to do well? I mean, what are your thoughts in terms of the overall space?
Absolutely, location is critical, and I think if you look back over the past 15 years, you'll find that the bigger assets have generally performed better. And that is one of the reasons why we're expanding our shopping centres, because with the competition around, if you are bigger and you offer a better tenant offering to the shoppers, you will generally perform better. That has been the trend for the last 15 years.
Yeah. So you've also highlighted that perhaps you could dispose of more assets going forward, and you've in fact said 10 non-strategic properties are in sight right now. So what assets don't fit into the portfolio anymore?
The assets are typically smaller assets. So either assets that are small and intensive to manage, that takes up time. In a portfolio of 146 properties, you're trying to get rid of the small stuff, and you're also trying to get rid of the stuff that that maybe design-wise is not great or location-wise is also not great. So there's a couple of criteria that we require. And that 240 million rands that we've sold, that on a forward basis is going to earn about 6.7% to Emira. And we are taking that capital and we are putting it into CapEx projects, which are going to earn us about 8.5%. So not only are we improving the quality of the portfolio, but we're adding to earnings as a result of that.
Yeah, I mean, let's just go back to distribution growth, because you saw 3.5% for this period. Do you think that you can even improve on that going into next year? What are you penciling down right now ahead of the year underway?
Sure, I think it's important to realise that although we've shown a turnaround, last year we were 2.5% down, this year we're 3.5% up. The Joneses, which is the rest of the sector, are delivering 6 to 7% earnings growth. And we believe that in the year to June 14, we can catch up with the rest of the sector.